Hola, muy buenos días. Bienvenidos a la conferencia con el tema de seguros de personas, desafíos de suscripción y cobertura. Es un honor que la AMIS me haya invitado a moderar esta sesión. Soy Carstens, director general de Seguros Azteca, y tengo el honor de presentarles a Carolyn Pritchard, quien es Vicepresidenta de Supervisión, Técnica de Suscripción y Desarrollo en RGA. Hello, Carolyn. Nice to meet you.
Very nice to meet you as well. Hola.
Hola. So I'm going to read a little brief of Carolyn Pritchard's resume. She is Vice President, Technical Oversight and Development in Global Underwriting at RGA. She is responsible for underwriting training and development for clients and RGA associates, including the integration and alignment of underwriting training programs offered by RGA and its RGAX subsidiaries. In addition, she develops best practice underwriting guidelines, manages retrocession relationships, co-sign on escalated cases from RGA business units globally, and provides technical expertise to underwriters on complex, unusual, and international high net worth cases. She develops and oversees client-facing global underwriting training, and is also responsible for managing underwriting relationships with RGA's retro partners. So welcome, Carolyn, and your session is yours.
Thank you very much. First of all, thank you for the opportunity to speak with you today. It's really my pleasure to be able to talk about underwriting with so many insurance professionals. I do have quite a lot to cover today, so in the interest of time, I'm going to jump straight into the presentation. So today I'm going to talk about the factors of change, some industry trends. I'm going to talk about underwriting innovations and give you some real life examples. The same with data analytics. We'll talk briefly about that as well and have a couple of real life examples. And then we'll wrap it all up with some overall conclusions and some takeaways from the presentation. So we'll move on to talking about the factors of change. So from this slide, it can be a little bit overwhelming. There are so many items on here, but really what I wanted to illustrate through this diagram is that there are a huge number of forces that are driving change at the moment. I'm going to focus on three key factors today. The first one really is customer experience and expectations and how they are driving change, demographics, and specifically around younger consumers, millennials and Gen Z. And we'll also talk about the pandemic. We can't go anywhere these days without talking about the pandemic, and COVID-19 has really made some accelerations to the change that's happening in life insurance in general and in underwriting specifically. So if we think about how we shop ourselves online and our expectations, our own expectations about how we want to deal with companies, whether it's an insurance company or any other company, online shopping really has changed consumer behavior and our overall expectations. I mean, we think about purchasing through Amazon or other online platforms, and it really does drive what we expect. So the popularity of face-to-face contact among insurance consumers really does vary by market. It's influenced by the maturity and the reliability of digital services in that market. The one thing that was clear, though, is that the more complex the requirement or the financial decision to be made, the more likely the customer actually would seek help from a person, whether that's by telephone or in person, rather than going online. What's interesting really is where customers are going for information. And there was a recent LIMRA study that really showed that social media is an important and growing source of information about financial services, financial products, and advisors. As we learn about how millennials, and that's the demographic ages 18 to 34, as we learn about how millennials make purchasing decisions, there really are some key differences with this emerging customer base. They're very comfortable with online purchases. Social media and friends are an important source. And one of the things I find quite frightening here actually is that 95% of millennials think friends are the most credible source of product information. And if that product information is complex like financial products, that to me is a bit of a worry. But another key factor about this demographic is that the companies they choose to work with really need to be seen as socially responsible. When we look at different consumers and their customer experience expectations, younger clients and specifically millennials have a greater interest in what's offered digitally. They value sustainability in making purchases, and they're more willing to share significant data on health, exercise, and driving habits in exchange for lower prices. And this is actually a growing segment. So if we look at how millennials would actually share data, or they will share data if they're offered things like lower insurance premiums or some type of a payment like a cash or a check as a rebate, or given coupons or gift cards. And the other interesting thing here to note is that they would also be willing to accept a charitable donation on their behalf. So the pandemic has also shifted consumers' expectations about the experience they want with companies. And here I'm going to talk specifically around financial services companies like insurance companies. So Accenture actually did a study, and they looked at all 42% of all consumers they considered as a reimagined consumer. And that really means that this group wants companies to understand and address how their needs change during times of disruption. Half are disappointed that companies don't really understand their needs, specifically during challenging times, and that this group of reimagined consumers does represent significant buying power, and it's something I think we need to listen to. So if we look at what the motivations are this group of reimagined consumers have in how they make purchases, there are 5 components. The first component is health and safety, and this really is answering questions like, are you keeping me and my neighbors safe? The next one would be service and personal care. Here it would be, do you remember me? Are you making my experience as personal as it can be? Are you there for me when I need you? The next one would be ease and convenience. So are you meeting me where I am in the digital world, the physical world, or a blend of the two? Are you able to deliver what I need when I need it across all channels? And then product origin would be things like environmental, societal, and corporate responsibility. Can you help me support my local community? Trust and reputation. Can I trust you to do the right thing for me and not just for your business? Can I trust you to be who you say you are and stand for the things you say you stand for? So 3 of these motivators I think are of particular interest to life insurance companies, and those would include service and personal care, ease and convenience, and trust and reputation. So when we look at a longer term strategy for companies in this post-pandemic world, if we can really say we're post-pandemic, we need to consider using a hybrid service model that leverages video conferencing and digital technologies and allows for co-browsing and collaboration. So some of this could be how companies interact with clients, whether it's offering digital or video conferencing with service personnel or with agents, or how we work internally in companies, because that has really changed as well. There are definitely new talent opportunities moving forward. And when we look at the change to work and how people go into the office or not, that location actually may no longer be a key factor, whether that is in recruiting new people or for existing staff to choose where they want to work. The world really is opening up quite significantly. So companies really need to consider new ideas from outside the insurance industry, especially for looking at digital customer service models. And to formalize changes made hastily at the beginning of the crisis when they were made, and then to assess what is long-term shift in customer needs. And then as we move forward, companies really need to look at their long-term vision, the culture of their company, and identify traits that are core to the purpose of your company and the value of your company, to be able to create a culture building program that drives the desired behaviors. So let's talk now about some industry trends. I've identified 3 trends. The first one, and this is really trends and how they will relate to underwriting. So the first one is digital transformation. This is things like looking at electronic applications and simplified processes and new sources of underwriting information. Then there are some staffing challenges, and in particular, the need for revising skills and capabilities and future-proofing your workforce. And then there is a look at what's happening around products and flexible product solutions. So things like shared value products, and here this would be sort of a wellness program embedded, things like a vitality program, or continuous underwriting with dynamic adjustment, and here it's dynamic pricing, and that would be based on customer behavior. And for example, the Japanese market has something called a pay-as-you-live premium schedule. So a few years ago, RGA actually did a life and health survey, and it was asking a number of companies globally how they were transforming their underwriting departments and how they actually were moving from traditional underwriting approaches. And the 2 items I've highlighted here really are around enhancing the customer experience, and consumer demand are key drivers of why underwriting in particular is changing. And as we asked companies about how they expected underwriting innovation to progress, there were 4 items that came up quite strongly: e-underwriting or electronic underwriting, big data and how data analytics would then be embedded into the process, dynamic or reflexive underwriting, and that is the ability to ask underwriting questions based on the answer that has been provided. So as an underwriter in a traditional model might go back and ask a supplementary questionnaire, dynamic or reflexive underwriting actually happens right at point of sale. Based on the answer to the last question, you'll ask the next one. So there's only information collected at one point of time. And again, it's looking at new sources of underwriting requirements. So in an effort to meet customer expectations about a faster and easier application process, insurance companies have introduced simplified and accelerated underwriting programs. Simplified underwriting, that essentially is simple application questions with a significantly reduced or eliminated non-medical requirements. Accelerated underwriting, on the other hand, uses alternative sources of information like prescription databases or risk scoring tools or things like electronic health records instead of the more traditional underwriting requirements like exams and medical tests. These two special programs were in place primarily in US markets prior to the pandemic, but the pandemic really has expanded these programs, both in terms of the ages of the clients that qualified for them and the face amounts that were allowed. And the other thing that has happened since the pandemic is that these programs are no longer considered special programs. They have moved to be mainstream underwriting processes. So the other impact that moving to more simplified underwriting has had, specifically in the US market and the Canadian market, where preferred underwriting is a big portion of the underwriting decisions that are made, by moving to fewer medical requirements and simpler application process, the trend is to move away from offering preferred rates. So let's look at the evolution of underwriting. And this is something that McKinsey actually has looked at, and they've identified 4 phases of how underwriting is expected to move over the course of the next 10 years. So phase 1 is the automation of underwriting processes to improve efficiency gains and to reduce inconsistencies. Many markets are in this phase at the moment. Phase 2 is accelerated underwriting, and this is where all applications are submitted digitally. In this phase, there's a dramatic reduction in the number of applicants that require invasive testing, like the blood testing and medical exams. And there's also a significant reduction in the number of questions on the application. And as I mentioned on the previous slide, the US is definitely moving into this, this phase now as well. So in the microsegmentation and personalization phase, underwriters develop a granular view of risk categories. This is using data sets like external open data or connected devices, and this would be things like wearables. And more personalized offers can be made with the same or enhanced accuracy compared to the current underwriting phase. Now, phase 4 is split into 2. So the first part is continuous one-touch underwriting, and that has dramatically simplified policy issue with dynamic adjustment based on the usage and customer behavior. So this would be data is shared back by the customer to facilitate on continuous underwriting. Think of having your mobile phone data or your wearable data be looked at every year by an underwriter, and your price get adjusted annually based on the outcomes of that data. And then in stage 4B, there would be personalized products and packages that are based on the continuous engagement, and then also to include interventions that significantly influence health outcomes. So next we'll shift over to staffing challenges. And this is making sure that we can reinvent skills and capabilities. And here I'm speaking specifically about underwriting. So underwriting is more than just a production role. It definitely has impact in terms of risk management, and that will only continue going forward. So workforce shifts won't actually eliminate jobs. The changes will shift the skills needed and new jobs will evolve. And COVID-19 pandemic really has accelerated this trend. So in a recent study of the life insurance industry, 25% of employees are within 5 to 10 years of retirement. And this is even more pronounced in the underwriting profession, especially because companies haven't been training new underwriters in the numbers that will be needed, especially with the role changing. And it's making the training of new underwriters more complicated because in the old days, when there was no automation of the applications, junior underwriters could look at these simple cases smaller amounts, no disclosures, those sorts of things. And so that's how junior underwriters were trained. But in the digital world, where automation is taking care of all of those simple cases and only defaulting the more complex, challenging cases to a real underwriter, a human underwriter to evaluate, that is really going to adversely affect how long it takes or will take to train upcoming underwriters. So as I mentioned, the whole underwriting role is in transition from traditional underwriting, looking at traditional evidence, to looking at new types of data. There are also more possibilities or opportunities for working remotely. And one of the things that we are seeing starting to happen is that it doesn't matter where an underwriter works, that you essentially have the whole world as a place that you can consider employment now. If we use the UK as an example, prior to the pandemic, most people would choose an employer or work at an employer in the same city where they lived. And the pandemic has changed that because more and more of the underwriters were able to work remotely. And now the underwriter chooses the company they want to work for as opposed to the companies in the location where they live. And I talked a little bit about the skills that will be needed. Underwriters, as we move forward, are really going to start specializing in things like electronic rules development, in evaluating new types of evidence and how to apply it in underwriting, how to work with data analytics. So those are all of the things that underwriters will need to be trained on as we move forward. And as we go forward, the role of the underwriter is actually evolving, and it will be much less process related, a task performer, and much more a custodian or an owner of the overall process itself. And as a result, it will become higher value work in the company, definitely less production line and much more strategy and risk management. And the best way I have to sort of illustrate how the role of the underwriter is changing is that traditionally an underwriter was looking at an individual case. It was low level, but it's now moving as underwriters are being involved more in strategy and in the data analytics components. Underwriters will be moving to a 38,000-foot view, managing the risk on a block of business and providing critical input as part of product development cycle, as well as data selection criteria for data analytics projects. So that's how I see the best way to illustrate change in the role of the underwriter. So let's move to innovations and what some of those innovations are. So there's electronic underwriting, there's some changes in electronic applications themselves, product innovation, the use of artificial intelligence, predictive analytics, behavioral economics, and new sources of underwriting information. Now, out of this, I'm really only going to cover 3 of them. I'm going to talk about behavioral economics and a combination of electronic underwriting and electronic applications, and potentially touch a little bit on the sources of underwriting information. So let's start with behavioral economics. And what is it? The best way to explain it from an underwriting perspective is to say, how do we make sure that clients tell us their medical histories accurately? And there are two ways that currently are happening. One is intentional inaccuracy. So this might be a person actually lying to themselves. I don't have a heart problem. I don't have cancer. So they don't own up to whatever the medical issue might be. Or they might want to be inaccurate because, say, around smoking, for example, and they know that smoking rates cost more, so they will forget or choose not to tell the truth about smoking status. So those are intentional inaccuracies. Then of course the other one is much more organized and criminal, and that would be fraudulent. But what happens more frequently really is around the unintentional inaccuracy. People might forget about a particular item that is relevant, or the way the question is asked, they might not be able to answer that question correctly. So underwriters are starting to use behavioral insights to design a digital journey, but these insights can actually be applied to more traditional paper applications as well. So this is looking at the entire process, looking at the marketing aspect of the need, the underwriting process, and ongoing servicing. But I'm really just going to focus on the underwriting aspect. So this is what questions to ask and when to ask them, and what words to use, how to word questions, customized underwriting questions, and how are we actually going to order those questions. So let's go to our first example. And this is Liverpool, Victoria. They are offering something called Quick Cover. And this is the first UK life insurance company that has actually designed an application process for mobile phones. And they've used behavioral techniques in how they ask the questions. So what they've used is how they're presenting the questions, what the order of those questions are, and how they're triaged. And what they've found is that 90% of the people who start the underwriting journey and the application actually finish it. And out of that 90% of applicants, they are actually having currently a 60% acceptance rate, and that's on an automated basis. So leveraging behavioral science, the way we're trying to do that from an underwriting design perspective is to improve overall risk selection and management and customizing our questions by encouraging and facilitating accurate disclosures based on how we ask questions and the order of those questions, and minimizing dishonesty, whether that dishonesty is inadvertent or deliberate. And that's to make sure that we explain to the customer what their responsibilities are and how declarations are positioned. So the declaration would be, I declare that I'm telling you the whole truth, the whole and complete truth. And research has found actually that you get better declarations from clients when you put that declaration of honesty and completeness before you ask any questions, compared to where we do traditionally, which is at the end of all the application questions. So let's look at a current version of an application question. Now, this is a standard application question, and as you can see, it asks about many medical diseases or conditions in one big long question. So let's move to the next version. Now here is a different way to ask the same question. It does look longer. It looks like it is more questions, but what it does is it simplifies the question actually by isolating each of the items, and that you can very quickly glance through and know you don't have any of these. It's much clearer and simpler. And so one of the things that underwriters get a lot of pressure to do at the moment is to streamline or simplify the application by creating fewer questions. And what that is actually doing is actually driving the opposite behavior. So to have fewer questions, underwriters are putting more and more medical conditions into a single question, and it's making the question more complicated and more difficult to answer. When in fact, if we expanded the question slightly, it might look like it's more questions. It might look like it's longer, but in fact, it's much more. It's much faster to go through and much easier to answer. So here's the second example, and this is coming from Different Life. I'm going to use there'll be a short video shortly, and this is coming from the UK, but the Different Life also is operating in South Africa. So there are a couple of key ideas to take from this recent example from Different Life. They are appealing to millennials through philanthropy, so the fact that one premium per year is actually donated, and also through the simplicity of the application process. They have very clear communication about what to expect during the application process. And they are also using behavioral economics, both in the placement of the disclosure warning, which they've done right up front, and in how they are asking the application questions. So if I use the smoking question here as an example, normally, traditionally, an answer to a question is yes or no, but that requires a client will actually try and make a judgment call about what answer we really want to have. And as a result, they could be enticed to provide misinformation. But if you give them a list of a wider variety of answers, you're much likelier to get the real answer to that question. And the same goes in the medical questions as well. We don't currently offer the opportunity to saying, I don't know the answer. So what has happened here in this company's example is that when they're asking about medical conditions, they say, yes, I have it, no, I don't have it, or I don't know the answer to this question. So now let me propose something. And I'm not sure how much you've heard about this as a possibility. So is it possible to actually underwrite based on a selfie? Is this fact or is this fiction? So the way it actually works is a photograph is taken and a system is actually trained to identify factors from a face that will determine age. It's very complicated. To be quite honest, I don't really understand it, but the base idea is to determine BMI or height and weight with just a face. So there are a couple of real-life examples of how this technology is in use. One of them is in India. Kotak Life introduced a life insurance quote based on a selfie. And here, selfie technology was introduced as a gamification feature for insurance in the onboarding process by attracting and motivating tech-savvy customers. And in the US, Quilt Insurance, and that's an online startup that was acquired by Mass Mutual, was also offering selfie quotes. But this company did recognize that selfie technology really doesn't provide 100% accuracy, but they didn't really care. They just took into consideration that fact in their pricing model, and they looked at it really as just a way to engage a younger customers and offering life insurance in a fun way. So let's move to data and analytics. And there's an example here with Humania Insurance. They created an underwriting platform called Hugo, and this is an advisor platform. And this platform uses predictive analytics to assess life risk and to make instant decisions at point of sale. And this is right now, up to 65% of their applications are going through automatically for up to $1 million of coverage. It's completely paperless. They don't require a signature. And the other thing is that when a case needs to have actual underwriting requirements, those requirements are personalized based on a risk profile of each client rather than on an agent amount chart. And then we have an RGA solution, and this is a solution that we have developed in our Asia division. And this is looking specifically at bancassurance sales and how we can simplify the underwriting process through those sales. So what could be done more traditionally is a simplified or guaranteed insurance offering and cross-sell or upsell existing clients on the spot, or potentially something called forward underwriting, which is offer higher cover on freshly underwritten lives without asking for any additional underwriting requirements. Or we have something called FAST, which is a fast algorithmic simplified track. And this is using learnings from predictive models that are built to utilize lifestyle and financial indicators as opposed to more traditional underwriting. So the way our FAST model works is we're using RGA's experience through predictive modeling, through our financial underwriting, through our wellness projects, and through other projects like data and behavioral science projects in Asia and then around the world. And it takes RGA's existing framework, a risk scoring framework that has been developed from our predictive and other scoring models, and then it calibrates with a bank partner and bank partners data. So looking at things like demographic data, financial data, lifestyle and transaction data. And then using this combination of factors is able to actually customize a simplified underwriting offer by segmenting clients according to risk. And so here are a few examples of risk factors and parameters. So there could be demographic risks, financial risks, or lifestyle risks. And all of those are actually taken through scoring. And there is a categorization that's done. There are some clients who are determined to be ineligible, and then there would be a customized offering for sort of each level of segmentation. But it is important to note that the quality of the segmentation really depends on the type and the quality of the data fields.
I'm sorry to interrupt, Carolyn, but I think we have to close.
Yep, I'm on my last slide.
Okay.
So I will skip. Can I skip to the second last slide, which has 3 bullets on it? Okay. So in conclusion, we really just need to say that as we move forward, we need to personalize every aspect of the customer experience, and we will need to develop flexible product solutions, especially in a challenging regulatory and interest rate requirement. And we need to make sure that our people are able to reinvent their skills and capabilities. And with that, I will thank you very much for your attention.
No, thank you very much, Carolyn. It was very interesting, and you raise a very challenging issues for the underwriting. Now, if you are okay, we can move forward to the Q&A session. I have a few questions for you. The first one, what are the trends in evaluation of long-term COVID and the impact of this condition on life products and fringe benefits?
So it is a factor to consider. One of the things that we are looking at now, specifically around COVID itself, if we look at underwriting new applicants with COVID, long COVID, and some of the ongoing concerns with people who've had COVID and have developed long COVID symptoms. It is a concern from certainly from a disability perspective. When we look at the that COVID has had, there have been some concerns around whether or not companies could put in new exclusions, policy level exclusions around pandemics. But what we did find this time is that even when there were policy level exclusions, that many governments stepped in and just said, you can't apply them. So the learning is that even if you have policy level exclusions for some of these things, that at the time you might need them, you may not be able to use them. And the other thing we found is that during a time of crisis like this, regulators do step in and put guidelines in place in terms of the questions you might be able to ask, or the limitations you might be able to place on applicants for insurance. We've certainly seen that lately.
Okay. And another question, what is your opinion about facial recognition systems for weight and height calculation and their usefulness in their subscription process or underwriting process? So
my personal belief is that they're a nice tool. There are a number of limitations with them, especially they use artificial intelligence to train the system to understand what is an appropriate height and weight, or the variations of height and weight. What has been found so far is that the performance really depends on the population that has been used to train those systems. So the more diverse, the more diverse the group of people who will be using that system. So whether it's culturally diverse or generationally diverse, the more diverse it is, the less accurate they become. So I just think they really won't be used much in underwriting per se, but they are an interesting aspect from a quote perspective. I don't see them taking off in any sense in use. There have been a few people trying that, but I don't think it's going to become a major player.
Okay. And the last one, with advances in science and technology, the life expectancy of the population has been favorably impacted, so that elderly population has grown. It is essential that the life and medical insurance make some changes to its products. For example, increasing the age of acceptance, modifying serious illnesses, promoting products such as long-term care. Should a different subscription process be considered for these people?
Absolutely. So in an aging clientele, so if we look at life insurance, for example, and when we look at older age underwriting, and in many markets, if we use a US market, for example, that underwrites up to age 90, very, very commonly, the need for medical evidence is much greater with that older population, because the protections of underwriting don't last as long with that group than they would with a younger group. The other thing is that we're dealing with different items. So there are always many more sort of comorbidities with this group. You expect people to be have more medical conditions and complications of those conditions, because that's normal and expected in the aging process. But the other thing we need to weed out, and might be more challenging to weed out, is frailty. So somebody who is older, is that person frail? And so there are some underwriting changes that have new underwriting requirements that have been put in place in markets that underwrite for these significantly older ages. So it does require a different perspective, especially because sometimes if you see something on a disclosure on an application in a younger client, might have a very different perspective on it from somebody who's older. And an example might be, oh, I tripped and fell and I broke my wrist. In a younger person, it's just a traumatic injury and easily managed. But in an older person, now you need to wonder, why did that person trip? Do they have a problem with how they walk, with their gait, and that caused it? Was it a problem of being unsteady on their feet or dizzy, or was there an underlying cause as to why they tripped? And then with a broken wrist, is that because they are more fragile? So it does change. The older the age of the applicants that you're underwriting, it does change the underwriting view in terms of what needs to be evaluated.
Okay, so, well, it was very enlightened, and it raises many challenging questions, because this underwriting process, I think, is changing every time. And now it has been, with the pandemic, it has been an issue, and the challenge is how to use the technology to cope with this pandemic in underwriting. And it was very enlightening. So I thank you very much for your presentation.
Thanks, it was my pleasure.
Yeah. So, pues bueno, pues muchas gracias, amigos, y pues esto fue la conferencia de Carolyn Pritchard, de seguros de personas, desafíos de suscripción y cobertura. Thank you.